Well, colleagues, while you are reflecting on the questions you may like to ask in a moment, let me use my capture of the microphone to ask a first question to Justin Lin. I'm curious about the relationships between the food price crisis and the financial crisis. You touched on that, and I would like to ask you to elaborate a bit more about it. What has been the implications of central bank reactions to commodity price booms potentially being part of the trigger mechanism to lead to the housing crash and the financial crash? Related to that, there is an interesting 100-year statistic by Rogoff and colleagues put together on the experiences of crashes in this century, in the last century. So it's a composite index. Since 1990, that index correlates significantly and positively to the global food price index. It did not correlate before. So the 70s food price crisis and the 1920s food price crisis did not show a crash relationship. Is that coincidence? Justin, would you comment a bit on these linkages as the world holds its breath, whether there will be a W crisis or a V? These are extremely, I'm sure you agree, relevant issues regarding what's going to happen to poor people if a double whammy is experienced.
Well, I think these are very good questions. And I think maybe we can have a joint papers on these questions.
Oh, yeah.
But certainly I'd like to give a very tentative ideas about how I see the linkages. Because as Russ mentioned, this financial crisis, if you trace its root, related to, the dot-com bubble burst in 2001, and because any bubble burst is likely to cause a recession, and to prevent the recession, the interest rate has been lowered down to about 1%, from 6.5% within a very short period of time, in March 2001 and 2003, June 2003. And that low interest rate certainly caused excess liquidity. And we see a lot of investment during the period of time going to the housing sectors. On the one hand, boost housing demand, but also promote housing construction. But at the same time, also cause a lot of capital outflow to other countries. So we see investment growth in many other countries. That's a real sign. That's good. But at the same time, we see the equity price, housing prices all increase and cause bubble. Mm-hmm. And in terms of the linkage, if in the U.S., if you look, in 2006, the U.S. already raised the interest rate to deal with the housing price bubbles. And we see the housing price started to decline in 2007. However, during that period of time, because of the boom, low interest rate caused so many real sector investment, and you had the wealth effect in the equity market, housing market, although the Fed started to deal with this issue. But the wealth effect is still there. And that's how we see people still have high expectation to think that the growth will continue. And even the interest rate has been raised, but with the high growth expectation and inflation expectation, the real interest rate to the speculators still low. And so we see the equity, the excess liquidity situation still there. And one example, one evidence for that was in 2007, we see the largest outflow of capital from the developed country to the developing country, 1.2 trillion. And because of excess liquidity situation, and the investment in the real sector seems to be secured. And so I do see speculation going into the new category of assets, including resources prices and also the commodity price, including grain prices. So we see that the grain prices started to surge in 2007, 2008. So that's related to the low interest rate in 2001, 2002, and onward. And I think your question is, how about in the future? Now we see again, the interest rate has been suppressed to so low. And are we going to have a similar danger? Certainly, I hope not, but there's a possibility. And especially compared to 2001 and 2002 during the period of time. In the 2001 and so on, at the time you lower the interest rate, you still have a good opportunity to make a real investment in housing construction, in the manufacturing sectors. And that supported 5-6 years of extraordinary growth. Russ discussed that. But this time, because in the housing sectors already excess supply, in the manufacturing sector also excess supply globally. So when you see the low interest rate, they don't have good opportunity in the real sectors. So very quickly, those excess liquidity, channel into the equity market. So we see equity market rebound so robustly. And in the real sectors, we don't see real sign of recovery. And that's a danger. Those kind of excess liquidity may also go into commodity sectors. We see that in oil, and whether they will go into the food sector, grain sectors, I keep my finger crossed. Hope we are not.
Well, I will send you an outline from Peaceful Bonn, and then we write that paper together. Ross, what's your comment on this linkage between the financial and the food crisis?
I think that Justin's focused on the main one. To the extent that the crash is a product of the boom, and it took much more than the boom to create this crash. But to the extent that it is, then the boom drove up commodity prices for real reasons, and the tightening of monetary policy, as Justin said, in 06 and 07 was the tightening of monetary policy in 06 and 07 was a response to the inflationary conditions. So there's a causal linkage there. And the crash has eased the real pressures on prices. There is I think Justin covered the whole ground. Just to emphasise one point, there are some signs that there are speculative elements now driving up commodity prices in this period of very low interest rates. In some of the major metals like copper, there are large increases in stocks at the same time as prices are going back towards record level, where people are choosing to hold assets in the form of commodities rather than invest in the real economy, because there's not confidence in continued real economic growth in the developed countries.
Thank you. I would like to now collect a number of interventions, comments, questions from the audience. Do I have microphones roaming around? Start here with Regina. Introduce yourself, please.
I'm Regina Birner from the IFPRI's Governance Research Program. Thank you for the very excellent analysis. My question is to Ross. You indicated that the world has learned from the Great Depression, and my question is what the world should actually learn from this crisis so as to avoid the negative consequences on developing countries that Usman and Schengen have pointed out so clearly. In particular, my question relates to the role of government. You mentioned as one reason for the crisis a reduced moral constraints on the behavior of individuals in financial institutions. Was there a role for government to actually realize that and step in perhaps with more or better regulation? That is one question. And the related question relates to the response of government. to step in and rescue basically the large financial organizations, perhaps because there was no other choice. But there's also the concern that that has created an enormous moral hazard regarding the risk behavior of these organizations in the future, especially if they believe that they are just too large to just government let them die. Thank you.
Okay, so we want to have just a moment. Ross, please come back, especially also to the too big to fail discussion. Liliana, please. Mike here.
Thank you. Liliana Rojas Suarez, a member of the IFPRI board. First is a short comment on your comment about the possibility of a W or bubbles and all of that. I'm not that sure about a bubble because there is one missing element for the formation of a bubble, and there is not leverage, increasing leverage. In almost every bubble, in every bubble we have observed, the credit has to be there. There has to be an overexpansion of credit. We can discuss that and perhaps talking about another book or something like that. But I would be more concerned about disequilibria, in persistent disequilibria, like the existing large U.S. deficits, the existing economic imbalances among currencies, among the major countries in the world. That's what I would be looking more in terms of potential problems for developing countries. That was my comment. Now, my question. Cheng-Hen, in your presentation, you explained very vividly about how Asia in general have stand well the crisis. But at the same time, you discussed and presented the different interventions, the government interventions, like agricultural subsidies, export bans. My question is how, and the question maybe is for Ross and Justin, how do you make, or also Cheng-Hen, I'm not sure, how do you make it compatible, the interventions that you have explicitly mentioned, with Ross accounting of the adverse effect of protectionism during the crisis, and Justin called for free trade?
Okay. I take 3 more, and then we wrap it up. I saw Siva had his hand up. Anyone here in these quarters? Siva, go ahead.
Siva, I'm saying from the Global Change Research Program. I know that in the developed world, many financial institutions have been rediscovering the joy of just plain vanilla banking. We know that we need complex instruments for certain things, but Dr. Lin, what is the World Bank doing perhaps to make sure that confidence is maintained in savings programs in developing countries? Are there financing plans to finance government-level deposit insurance schemes to make sure that developing countries that are still on the path in increasing the savings at the household level continue to do so despite uncertainties in world financial markets?
Okay. Anyone else who would like to have a... Yes, Cecilia.
Thank you. Cecilia Lopez, a member of the IFPRI board. I was wondering, Dr. Lin, it was clear that those economies that were more integrated to the world economy suffered the most. But then, for the recovery stage, why don't you talk about the internal market? Why you keep on insisting that you have just to have more trade? Thank you.
Thank you. If there are not particularly urgent points, I'd like to give our panelists a chance to comment not only on some of the questions which came from the audience, but also on each other as the presentations progressed. Ross, would you be so kind to go first?
Yes, so Regina asked me some very important questions. What are the lessons we should learn from this one? Well, the one lesson is that Keynes knew what he was talking about. The expansionary policies, when you are in deep depression, actually work. This is the first time it's ever been tried on any scale. There's been no time since the Great Depression when it's been needed on this scale. And in the Great Depression, we didn't try it because we didn't know about it. The other lesson, the more specific lesson, is yes, what it is now very clear that much closer regulation of the financial sector is necessary. Well, at least in the United States and some European countries. Some developed countries have had much tighter regulation and didn't go through the extremes of deregulation that, for example, the United States and Britain went through. Australia and Canada are examples, and they didn't have crises on the asset side of their banks' balance sheets. They had other problems. They were not without problems, and we kid ourselves a bit about not having other problems, but we didn't have those same ones. And that's closely linked to the question of moral hazard. I think that the legacy in the developed countries that have bailed out their banks to the extent that the United States, Britain, some of the continental European countries have done is a very dangerous one. What we've covered up the problems through huge public injections of money. We've consolidated banks, so it's a much more monopolistic situation now than before. So if banks were too big to fail before, they're much too big to fail now. We've left the impression that if bank executives to enrich themselves take huge risks and they come off badly, they won't pay for it. So it's confirmed the one-sided nature of the risk, and I fear that we're in a more vulnerable position now than we were in 2007 because we haven't dealt with the regulatory lessons. And what's necessary in the way of regulation? Well, I think it's important to recognise that it is in the financial sector that the problem is. This doesn't make a general case for widening government intervention and regulation. It's a problem of the financial sector. I think the comment that we had from the floor about the value of pure vanilla banking is an important one. There was a big debate in the United States at the beginning of the big lurch into deregulation in 1987 with Volcker and Tobin on one side, Greenspan and others on the other. Volcker and Tobin lost. The world would be different now if they'd won. Got to go back to some of those sorts of ideas that we do need financial institutions that can't fail, that people can have confidence in with their deposits, ordinary citizens, but they have to be very closely regulated. They should not be involved in clever money, and that's what Tobin and Volcker were saying in 1987.
Well, Usman, any intervention you would like to make at this point as we close?
The only point I would have perhaps brought on the table is to continue your discussion with Justin Lin about speculation and return to commodity speculation, what it does to investment and FDI in land in Africa. Okay, I was going to link the return to speculation with the drive to invest in land in Africa and deconnecting the poor people from the only asset they have, which is actually the main difference between Africa and Latin America. They could invest in the land to get out of poverty. So what it does to stability and peace and what other things you have down the road, and then longer-term growth is going to be a real important aspect, I think.
Thank you. I suppose Justin will invite you to write that paper with him. Shengang?
Well, I have one comment about Joachim's question. One important element.
Speak into the mic, please. Yeah. No, it works, but you need to speak into it.
It's energy. I think the food price to some extent is triggered by energy. It doesn't work. Yes, I think this link between food crisis and the financial crisis is missing one important element, that is energy. So I think the food crisis to a large extent is triggered by energy crisis, and energy crisis is triggered by the certain financial problems already there in the commodity market. So that's just one comment I wanted to add there. Then in terms of protectionism, yes, indeed, we have to make sure the protectionism will not be used to deal with the financial crisis just to protect your own economy. And similarly, internal market, yes, indeed. Many Asian countries like China really needed to boost their domestic demand. I mean, that's the probably the most effective and long-term way to solve even this global disequilibrium. So now the Chinese is has kept saving, America has kept spending during the crisis, but this really needs to be changed.
Justin Lin, last words.
Okay, first I'd like to respond to Lilian's optimism, and I hope I can share the same optimism. And the reason why you are optimistic because you do not see high leverage. However, okay, but we know that every crisis can be caused by some different mechanism with the same spirit. Because we haven't seen the high leverage, but we see the large fiscal deficit that need to be monetized. And that also means increased money supply. High leverage increase the supply of credit, but large deficit also increase the supply of money. And that might be the channel. So maybe, bubble is there because although the channel is different, but bubble may be there. That's one concern. Secondly, regarding how to increase the confidence of people in Africa to increase, their saving and so on. Certainly, the saving deposit is one way. To improve the regulation to reduce leverage and to prevent the possible crisis is the other way. But in other writing, I strongly argue it's also very important to improve the financial structure. Because in low-income country, the majority of production activity are carried out by small agricultural households or small and medium-sized firms in manufacturing sectors and in service sectors. And the best way to serve those kind of economic agent are local small banks. And if you can help that, the return to capital will be higher, the economic will be more dynamic, will provide more job, and they will have more money to save. And they can also turn into a more dynamic economic growth. And that is another way to increase the service of the financial sectors. The second one about the openness and vulnerabilities. I think that not necessary. If you look in the past 2 decades or 3 decades, India, China, and South Asian country, if you look in the trade dependence, they all increased dramatically. But if you look into this financial crisis, they are very resilient. So the statement more open cause more vulnerability is not supported by the empirical evidence. But that may be related to how you open your economy. If during the economic openness, you follow your competitive advantage, as I argue, then under the kind of situation, there will be more resilience. If you still, try to go against your competitive advantages and you open your economies, and under the kind of situation, the development path for a period of time, you have to rely on capital inflow to support your investment in sectors which are not competitive. And when a crisis comes, you will be more vulnerable. That's one thing. Secondly, regarding the internal market, I think that if you are following the competitive advantages, trade becomes endogenous. You export in a sector which you have competitive advantages. And it will increase the import in sector which you do not have competitive advantages. So under this kind of situation, trade will promote export. Trade will also promote import. So the situation will be balanced, basically balanced. You may expand the market to other people, but you also create a market for other people. And certainly now there's a lot of discussion about the global imbalance, the needs for the U.S. to increase saving, the need for China to increase the consumption. For that, I have no argument. But in other places in my writing, including a chapter in a book edited by Professor Garnaut in the China Update 2008, I think those kind of structural reform is necessary and it's very important, but structural reform in general take time to, implement. Thank you very much.
Well, thank you, panelists, for addressing in far too short presentations an extremely complex set of issues which the world is currently wrestling with, and still providing sound analysis and moving us forward to a set of actions which I think cut across as agreement, appropriate levels of regulation, fight protectionism, address the volatility issues in markets with innovative ways, as Justin Lin also outlined, increase productivity, enhancing investment so that the resilience comes through the economic growth process, the resilience of the poor, and add social protection actions in order to address the livelihood issues of the poor. Lots of open questions. We look forward to further writings from these giants in the field. Thank you for your questions and for coming. Applause for the panel, please.